As a trader, you don't just make an entry. You make entry based on certain criteria. And we've established that we'll begin trading by determining the direction of the market, which is the trend, either bullish, bearish, as the case may be. And once we have identified that, we'll go further into marking our point of interest. So our point of interest are those areas in which we expect price to pull back to for us to make our decision of either a buy or to sell. To all our new subscribers, thank you for subscribing to the channel. Officially, I say welcome to Royal Forex Academy, where we share with you profitable ideas that can turn around your financial journey. A big shout out to all our returning subscribers. Thank you for the support. It has been massive and we are grateful to you. In today's video, we are looking at understanding fair value gap. One of the points of interest where we expect price to move from, we said we mark area of support and resistance, supply and demand zone, our order blocks. One of those critical zones where price make a reversal from is what we refer to as a fair value gap. In a way of introduction, in trading, fair value gap means gap between an asset, which is the current price, and its fair value. And this is caused by market inefficiency or imbalance. So just as you are seeing here, in a bullish move, this is a typical fair value gap. So this zone here is our fair value gap. And in a bearish market, this zone here is our fair value gap. The question now is, how can you identify this zone and this zone on your main chart as a trader? So what we'll be doing in this video is just to teach how we can identify and how we can mark out our fair value gap. So let's go back to our chart. Price move from this support zone and begins to push to the upside. When price was making this movement, we need to study how the candlesticks behave. So what do we do? Let's begin with this candle. This candle opens here, it pushed to the downside and then move up and close. After that, followed by this candle, then this particular candle, then this candle, then this candle. Now this fair value gap is caused by institution. So one of the way we can determine a valid support or a valid order block or a valid supply and demand zone is that it creates an effect. And one of those effects, aside that it has to take a liquidity, one of the effects is that it will create an imbalance, which is a fair value gap. So from here now, this zone to this point, there is a fair value gap. We can see this long candle and we are not seeing any other candle that fill in this gap. So if we want to mark a fair value gap for this particular candle, okay, so I'm going to pick a horizontal line to identify. Yeah, I'm referring to this candle. So this candle with my vertical line is the candle we want to identify a fair value gap on. So for us to identify this fair value gap, there are certain criteria, certain things we want to see. Number one is you will mark the high of the previous candle. Okay, so this is the previous candle. Before the candle, this candle is the previous candle before this candle, while this bearish candle is the candle after this candle. So you are going to mark the high of the previous candle and the low of the candle after the candle under consideration. So what do? I'm going to pick my horizontal line, and I'll mark the high of this previous candle. So I just mark the high of this previous candle. Then now this is the candle under consideration. I'm going to mark the low of the candle after for an uptrend. Please, you have to watch this video over again in order for you to understand this concept. It is very important and it is critical for trading. Now you can see this. Now this is the candle after. So this is the low of this candle, and here is the high of the previous candle. Now you can see that there is a gap between this particular candle and this other candle here. So this gap we are seeing here, there is no subsequent candle that have filled this space. So this space between here, this gap from here to here, is what we refer to as a fair value gap. This is an improper price action. In an ideal trading situation, price is not supposed to leave a gap in between, and that is why you see price move in a certain way. It's supposed to be moving like this. As this one forms, the subsequent one will overlap. The next one that is going to form will overlap. So you will now realize that this connects this, this connects this. You now see that the next one too is now going to overlap. So this is how candles are meant to form. When this ends, it will overlap. It will overlap. The next one that is going to form will overlap this one, and then it will continue this way. So this is how candlesticks are meant to be formed, overlapping one another without leaving a space. But in this scenario, there is a space. So this space is what we refer to as a fair value gap. So you can see that even when price retraces down, there is still a gap in between these ones. There is still a gap in between here and here that is yet to be filled by price movement. So all you need to do now, you now pick your rectangle or your square and mark out this zone. So you see now, we'll now mark out this zone, and this zone becomes our target for the future, because by the law of trading, price is supposed to fill this imbalance. Price is not expected to leave imbalance. It is expected that price filled this zone as far as trading is concerned. So later in the future, price is meant to fill it. And look at what happened. Price left, went to the upside, created resistance, okay, and price returned beautifully back. You can see it now. Immediately price finish filling this fair value gap, it returns to the upside. So you can see how this plays out beautifully. Immediately price filling FVG means fair value gap. So this price came back, fill it 100%, and then it begins to move to the upside. The goal of this video is to explain to you how you can identify this zone. Then the subsequent video will be looking at how we can make our entry in trading this fair value gap. All right, so you can find it on and on, and you will see it most of the time in this price scenario. Now here is another one. Let's look at this. Is for a downtrend, so we'll be considering this particular bearish candle. So this is the bearish candle we will be considering, this particular one. So what do? We will mark the low of the candle before the candle under consideration. Okay, so we are going to mark the low of this bullish candle and the high of this bearish candle. So what is the low of this bullish candle? The low include the wick of that candle. So here is the low of this bullish candle, and then here is the high of this bearish candle. So you can see how we mark this. Now, why are we not marking all of this other candle? It is a candle that shows institutional movement. Retail trader cannot move price with such force. So it takes an institution to make such movement. Now that we have marked the low of the previous candle and the high of the candle after, you will see this gap now. Automatically, the space in between becomes our fair value gap. So this zone on this candle is what we refer to as our fair value gap. And then look at what happened. Price came down, right? Price came down, and look at it. Price pulled back, fill it 100%, and then continue to the downside. Is it not beautiful how price respect this?